Good evening. This is Ken at Tortoise Capital, and now we're going to build our standard regression line crossover framework common operating picture, starting with the default settings at free stock charts. Remember last time we had shrunk the Chrome percentage down to 67 so that we maximized our screen space, minimized the area that the ad would take up, which gave us small, almost unreadable symbols over here, and made it hard to read the menu bar. So for purposes of this exercise, what we're going to do is we're going to bring this up to 120%. Now you can see that we've increased the size of all our headers, and it'll make it a little bit easier to read. All right, so let's start with our settings and our plot style. We're going to use the high, low, open, close. We're going to show yesterday's close line and today's open line. We're going to show up and down bars as red and green, and hit OK. Now, we don't need volume. We're going to show volume as later on. We're going to build out volume at price on the left-hand side. So we're just going to get rid of volume for right now. We're going to shift up to daily charts. I'm going to clean up the screen. If I have a lot of drawings, I can just go to drawings, delete all the drawings, and that gives me a nice clean screen. Now I like a white background. I think it's easier to see. It's like footprints in the snow. And so I'm going to come to settings, properties. My back color I'm going to select as white. All these others are fine. Now we're going to take a look at some properties of regression lines and why I like using them. So we're going to come up and add an indicator. And we're going to pick a linear regression line. We're going to select price history. And it defaults to 30. And then we're going to add another regression line. Pardon me. Add indicator, linear regression line. And now you can see we've got a linear regression 30 and a linear regression 30. So we're going to edit that and make that 10. And we're going to color it blue because our 10 is blue. And we're going to show the 30 as black, as we do. Now, what I want you to notice is that the 30-period regression line is a very good description of the price behavior of the last 30 days from here to here. And the 10 is a very good description from there to there. Now, if I add a trend line, what I want you to see is that if on this 10 days ago, price had turned this way and it went down as far as it went up, the 10-period regression line would look very much like the line that I've just drawn. The 30-period regression line would still be mostly up. It would have adjusted a little bit. The 30-period would look something like this. Oops, excuse me. It would end up looking something like that. We would have a 10 period focusing down and a 30 period focusing up. Because the 30 period is looking at this move and then here. And the 10 would only be looking at that move. And so we would have a difference of opinion between the fast traders who would see price moving down, and the slow traders who see price moving generally up. And in that difference of opinion, the traders are going to be moving price in one direction or the other to see which one is correct. Now, it gets cumbersome to keep drawing these regression lines. And the 30 should actually terminate here. It's cumbersome to keep redrawing these. The screen will get very busy. What we really care about is the endpoint on each regression line. The endpoint on the regression line is the point at which the regression formula computes the perfectly placed price based on all 30 or all 10 data points. The difference between the actual price, for instance, the closing price, and the 10-period regression line is a small error. Against the 30, it's a slightly larger error. And that error factor tells us how good of a fit the regression line is for the variation in price. You can see when there's a great deal of variation, the regression line error function is large. When price is converging and very close to the regression line is a good descriptor. Now, in order to keep this from getting too cluttered and to account for the changes in the regression lines daily, instead of drawing 30 regression lines and watching how they change, that would clutter the screen and obscure the price. What we can do instead is add an indicator called moving linear regression. And so when we put that on price history, you'll notice that what we have now is a 30-period linear regression, a moving linear regression. And so since we want to make that black, what we would see is that as price begins to vary its directions, the moving linear regression line simply is making a curved line out of the endpoints of each successive 30-period regression line and only drawing those predicted endpoints. And what that lets us do is remove all of this extra noise and allows us just to focus on excuse me, allows us just to focus on the residual predicted price. And so I'm going to add another moving linear regression. Put that on price. We're going to color that one blue because that's what we do for the 10. In order to make these really stand out, I'm going to increase the thickness to very thick. And my blue one, I'm going to make that 10. Pardon me. So now what we can see is the difference of opinion between the fast traders in blue, his opinion about what the fair price is, or the real price, and the slower, smoother, but slightly lagging opinion of the slow trader. So slow trader and fast trader. Now, at the end of what I want you to notice is at the end of a long trend, the disagreement between the fast trader and the slow trader is at a maximum. And then when the trend line changes and starts to move back up, you'll notice that the blue line quickly follows the price and adjusts, and that this regression line crossover is the official end, in this case, of that long downward trend that was signaled by this regression line crossover. When price persists in going up, even after this double bottom, the slow trader slowly turns, and when he starts going up, now the fast and the slow trader are both in agreement about the long-term trend. So when we see this crossover, we see there's another period of time in which the difference of opinion is large. And in this case, it took more persuasion that the fast traders ran out of juice, couldn't keep it going straight up. ran out of gas, came back to the fair price indicated by the slow trader, and then both moved out together. So we can think of the fast trader as indicating the beginning of a change of trend for price, and then the confirmation comes with the slow trader. And that's the beauty of having the factor of 3 between the slow mover and the fast mover, so that when the fast mover changes, when 10 price bars change, he's already pointing up, and the slow trader moves from down to sideways. When another 10 come along, now he's up, and then now at 30, they are in complete agreement about what price is and what it's doing, and that is going back up. So that's the essence of the 10-30 pair for the regression line crossover. Now, this is the fast and this is the fast pair. And if we go back in time, we can see how smooth the slow trader is to find these changes in direction, and that the aggressive fast trader can actually find opportunities to trade from here to here, but it takes some persuasion, if you will, to get the slow trader to change his mind and resume. And once they're in agreement, you have the beginning of trending behavior, which can last for quite a while. And when they peak, the same thing happens on the upside. You get the first one, second one, confirmation, and now the trend is down, and now it's the big fail. Warning of change of trend, pause, refresh, resume together, the big long trend. So we are paid for paying attention to the opinions and the differences of opinions in the opinion of fair price by the fast trader and the slow trader. Now this is what it looks like on daily charts. Same interpretation on any time frame. The difference between fast and slow is fractal in nature. If we looked at hourly charts, you would see the same phenomenon. Down, then up together, and the crossovers indicate changes of opinion. Here's where they are in complete agreement. If we look at 3-minute charts, you see the same characteristics. Changes in trend, the confirmation occurs, crossover in complete agreement, continuation in agreement, getting ready to roll over. So that's what we are looking for just in the use of the 10 and the 30 regression lines as proxies for price for the trading pair. If I'm using a 10-minute chart and I want to see what's happening on the 30-minute chart, like is that trend starting to peak on the 30? What's it look like to that higher time frame? I could either go here and change it to a 30-minute chart, or if I add a 90 period moving linear regression and color that green, make that 90 and thick. We now have the relationship between the 30 and the 90 on a 10-minute is the same as the relationship as the 10 and the 30 on a 30-minute. So we get to see higher time frames by simply interpolating the regression lines. Now the relationship between the 10 and the 30 for traders is the same as the fast and slow relationship between the 90 and the 270 for the holders. So let's add the moving regression line. And we color him purple. $270 and thick. Pardon me, not the 2700 period. Let's just use the 270. So the 270 was pretty sure that the fair price, the fair value, was up consistently and really treats these excursions as noise. Almost never changes his opinion. Once things start turning, he likes it. And that's true on 30 minutes. On 1 minute, starts here. It takes this much price action to make him roll over. And then once the price changes and starts going up, it takes this much price action to move him from down to sideways and then to slowly convince him to move up. The 90 is intermediate. See how that changes and then starts to, and then it confirms, and then the 10 stays right with price the whole way, and then the 30, the slow trader, is a smoothed price. So the purple line is the slow holder's opinion of fair value, and really the market psychology in the long term. And that's what it looks like on 1 minute. If you go out to a daily, you get the same impression. Things were going along fine until June, July, and early August in 2015 in the markets. Things were going up. The market had moved from here all the way up to here, and this was the fair value. And then life happened, and the 90 started to collapse. The 10 and the 30 quickly collapsed. This great big sell-off here in August 2015 was enough to really shock the long-term holders and making decisive changes in what was fair value. And they met somewhere over here in the middle periodically. And then another big sell-off in January caused the opinion to drop down. And now this move, this 10% move off this double bottom, almost back up to this previous highs, is enough to cause that long-term fair value to reach the 6 o'clock position and start to hook up. So you have the 10 and the 30 already decisively up. The 90 changed right over in here, was convinced, and now the 270 is convinced. So things are starting to look up in terms of the long-term and the short-term holders. And so we may have a market condition that looks like this. So these regression lines, the fast pair, the 10 and the 30, and the slow pair, the 90 and the 270, give us some insights into the opinions of price and fair value based on these different demographics. And they work, the interpretation of this metaphor, this framework, this sense-making structure is identical in each time frame. We can go out and look at weeklies, much longer term, and now we're looking at 6 or 7 years, and you can see how the long-term fair value is still pretty high, but starting to peak. The activities of the last 2 years have really put into question this long-term gain all the way from 2009, when the price was at 70 in the Dow, in DIA, and has moved to 180, almost a 200% gain. And so one shock recovery, second shock and recovery is enough just to slow down that longer term impression. The fast holders have already changed their mind and are grateful to be preserving their gains and are very cautious now to see what this looks like. This is reaction to the Fed this week and this little recovery. How vulnerable is that to this kind of change in market condition? The long-term holders on the weekly charts are concerned. If we go up and look at monthlies, we don't even have a 270 months worth of data, but you can now see how the 90 on a monthly resembles the 270 on the weekly. So you get this fractal nature. Now, these great big divergences now look interesting on a monthly basis. Does this divergence lead to that? Do those divergences to the downside lead to another leg up? Or is this some of this? That's why we get paid to find out. The last time we saw the 10 and the 30 roll over and cross the 90 was back here. This is the nearest neighbor to that kind of condition. And so this cautions us to say that 140 is in play on the downside. We threatened it twice. They were able to run it back up, but there's still enough concern here coming into an election year that 140 is not unrealistic on the downside, and that's if it holds there. 120 is in play. So we'll keep that in mind. And the regression lines give us incontrovertible evidence about interpreting the opinions about fair value and price for these different time frames. So that's what I want to say about regression lines. When we consider the regression line fractal framework, and now we're looking at dailies, one of the things that we can do is look for these divergences of opinion between the 10 and the 270. This was a moment of maximum divergence between the 270 and the 10. So now if we zoom in on this rascal, when the 10 starts to roll at a period of maximum divergence, when the 10 starts to roll upward, we have reasons to start trading in the direction of the meeting of the minds. We've been calling this a triangular trade. That if we simply extend the lines into their natural directions, we get something like an estimation, and if that's the midpoint, we can now start looking at the price, and then the 10 crosses the 30, 10 crosses the 90, 30 rolls over, crosses the 90. Together they go join the 270, which is slowly adjusting his opinion downward, and now we have this climbing the wall of worry. And what we can now look at is expressing the distance between the 10 and the 270 as a function of average true range, and then computing 1, 2, 3, and we can express that move in terms of reward versus how much risk we want to take. And if we put a stop down here, we get any kind of entry in this area, we're pretty happy all the way. That is a strategy that we call the regression line fractal framework, but it comes out of this interpretation of regression lines using the metaphor of traders, the foxes, holders are the hedgehogs. Owl and the tortoise using wisdom, persistence, and patience to frame trades and then manage it. Looking at fast pairs, slow pairs, standard screen markups, and using the fractal nature of the lengths of the regression lines that we've chosen to give us actionable information in time to make a difference, and to allow us to see the opinions of different time frames expressed on a single chart to give us some management capability, and then we can start framing trades in a way that is disciplined across the time frames. So that's what I want to say about regression lines, and a hint about the regression line fractal framework. And I've shown you how to add those indicators through the use of the moving linear regression. On your chart package, you may also see that as the least squares moving average. But if you use free stock charts, you're in good shape. It's Ken Long from Tortoise Capital with their lesson on regression lines.